Before we jump into blockchain and financial markets, I'd like to read out a message first for you. That was not the message that was sent to me. It was a distress signal call. Come here as quickly as possible, old man. Now, that was a wireless telegraph that was sent from Titanic to Carpathia, which was a ship that came to rescue people from unsinkable ship. Not long before that, New York Times have labeled wireless telegram technology as superficial, sudden, and too fast for the truth. Too fast for the truth. Well, on that night, it was not only not too fast for the truth for the 700 people that survived, but also, unfortunately, it was a bit too slow for 1,500 people that didn't. I like to tell the stories because it's important to me to leave you with something after this presentation. And if there is anything, that would be that blockchain will inevitably be the single and the most important source of truth for financial markets. Now, blockchain has its fair share of criticism, as you are all aware, especially in the last couple of years. But in reality, so did internet, GPS, and nuclear. Now, internet has become such an important part of our lives that many consider this to be a human right. And without GPS, we would be still navigating using red books called Michelin guides. Now, without going into too many details, I would summarize that blockchain is actually something that is very, very familiar to you today. It's simply a next iteration of a database, much more superior than what we had before. A napkin, a SQL database, an Excel, or Google Sheets where you all collaborate today. Blockchain adds immutability to the records, and the records that you can also verify. So it's just better version of what we had already before. Now, due to the fact that the records now can be transported, blockchain also allows you to implement rules and force the rules on the transparent information. Let me explain further. The largest collapses in recent history has shown us how important good quality information is. If information was true, those collapses were preventable. And as a matter of fact, accounting has been, if not the main problem, then one of the main problems of why those collapses have occurred in the first place, because you can manipulate Excel sheets all day long, but you can't do the same with blockchain. Overarchingly, we can conclude that bad information just have devastating effects on society. And the most recent example has proven how detrimental those effects could be, where we have cases between Archegos and Credit Suisse with over-leverage. But more importantly, the other side did not have a full picture, and no one had a full picture. So we can see as how one episode can bring down to its knees institutions which are 100, 200 years old. Transparent information and on blockchain is not just going to be a good friend for the regulators. It will be a necessity. Regulators are not fortune tellers, so they don't have a choice but to be reactive. And from the slide, you can see it takes on average 4 years for the regulations to be implemented. Now, at that point in time, the damage is already done. And there is another crisis brewing in the background, and no one knows where. I want to bring us to a little bit of a different industry and show what sort of things have come, what happens in aerospace. So as you can see here, there are a number of flights departures and the fatal accidents per million of flights. In 1970, fly-by-wire systems got introduced by moving manual operations in aircrafts onto the electronics. And at that time, the reliability of the electronic systems were also severely questioned. Now, today, we don't have live reconciliation of data in financial markets, so autopilot is simply not possible. But we do need an autopilot, and blockchain can definitely help with that. Now, why aerospace had to implement this? Because there are human lives at stake. I would argue there are more human lives at stake when it comes to financial markets and well-being of people and their families. It just never makes the headlines. So let's now, after we've talked about all the deaths and Titanic, talk about blockchain. There is a myth in blockchain side that blockchain is not fast enough. And there are different blockchains competing as to what's the fastest way to buy a coffee. It seems like a lot of people are really obsessed in the blockchain space around purchasing a coffee, which I generally don't understand. There is a $9 trillion in FX overhang every day. That means that that's something that sits there without any PvP protection, and if the system glitches or there are world events unfold, that's the value at risk, essentially. And those are the average speeds today on blockchain. Now, I would argue that 3 minutes is okay. If not 1 second, not 10 minutes, you can pick and choose. We have that technology today, so we need to focus on implementing it rather than figuring out how to pay for coffee faster. Let's argue for a second that markets are efficient, and let's look at the financial markets today. Most of you, if not from your day jobs, but maybe from the movie Big Short, know what CDOs are, hopefully, by this point. That was an instrument that's largely responsible for bringing down to its knees financial ecosystem and resulted in global financial crisis in 2008. There is also collateralized loan obligations, which granted, they have better risk profile, right? Those are commercial loans, derivatives, essentially. And in finance, we generally love to package things and that people don't understand and essentially see what happens. Now, IMF estimates the losses from CDOs during the GFC were somewhere between 230 billion to 300 billion. Well, money was cheap before the interest rate hiked. So now all the commercial loans need to be refinanced at 5% or thereabout, well, 5% plus or thereabout. In 2023, that number was $107 billion. Next year, the total number is going to ramp up to 350. Year after to 750. And by 2027, $1.5 trillion have to be refinanced at new interest rates. Now, that statistic would be okay if Federal Reserve would not estimate that 37% of companies are close to default. And also Moody's said that the 3-month trailing average of default rate has doubled in the last 6 months. So what does it mean? Some people know where those products are, who's holding it, and what are the constituents there. But that's not the entire market. Creating opportunities for people to act on different pieces of information. This asymmetry of information is what creates inefficient markets, resulting in financial crises, resulting in larger requirements for capital to be put out, and so on and so forth. Now, the way people think about blockchain is mainly on the left-hand side, right? This is what we think about blockchain. We think that, it's tokenization, interoperability, scalability, transaction finality, etc. The biggest value, and I cannot stress this enough, comes from the real-time information. Leveraging the real-time information. What Copper has done for the last 6 years, we ramped up to about $100 billion of contract value traded every month with 10,000 risk-reducing settlement events, which are being flushed out of a system in terms of the risk every 4 hours, 24/7, 365, with 8 people in middle office. Now, those people do not have fails because they work on blockchain. We'll leverage this information, we'll leverage the technology to basically drastically reduce how many people required to operate the markets. And they're not too dissimilar to traditional markets that people operate in today. So one of the things that we also wanted to mention is that on the tokenization front, this is another interesting topic that's been quite overused. Tokenization on its own, it doesn't matter. The application of tokenized assets is what the true power comes out. So what Copper launched here in Abu Dhabi today is a business which basically takes the infrastructure that we've built over the last 6 years and service over 500 customers for, and want to apply it to traditional markets because we prove that this works in crypto and this could have phenomenal effects in traditional markets. We're also bringing traditional markets with us. So there is cost connectivity to traditional finance. And we're also making sure it's cross-compatible across the existing ecosystem. Obviously, there are quite substantial improvements that could be made by putting this onto smart contracts, which will create clearing and settlements much faster, and reduction in the staff that required for middle and back office will make it cheaper. I mean, that on its own creates a much better environment for the clients. However, due to the new shift in variables that are required to create and run financial products, we will see better financial products that hasn't existed there before because they were not economically viable. But that's the conversation for 2024. Thank you very much.